Guys, we are testing with Freddy just how to go live together. It's the first time that I use this function in WAP. So we will start in 10 minutes, as always, at the opening of the New York. So if you are here, know that this is a testing phase for the next 10 minutes to let Freddy join directly from here. It works. Now let's check with the chat. Let's close this call and let's see directly in WAP, activate the microphone and let's see if it works, Freddy. Just 1 minute. Okay, let's see. Hi guys, can you see also the presence of Freddy in the call, or you can see only me? I should have been able to add Freddy. Okay. Okay, so it should work. Okay, now it's here. Freddy, try to share the screen just to see if everything works. And try to activate the microphone. Let's make the test. Yeah. Let's see if he's able to share the screen. Oh, it's visible. It works, it's visible. Try to talk, Freddy. Open the microphone. Try to talk. Yeah, he prepared the whole presentation. Let's see. Okay. What you need to do, Freddy, is activate the microphone. No, it's not shy, Freddy. Just you have problems with microphone. That's the reason I started a little bit before, so we can fix all the problem together. But you can see in the call that Freddy is here, right? You cannot hear him speaking. Okay, we can see Freddy, but we cannot hear you talking. He's doing some test. Yeah. I cannot unmute directly from here. If you cannot talk, let's sing like Freddie Mercury. Yeah, this is the plan, Jacopo. But we connected before to solve all these issues. If we see that there is any kind of problem, we will go directly with the Zoom. Try to talk, Freddy. I can see the presentation and I can see also the high quality presentation. The connection is good. I cannot hear you talking. Yeah, same, guys. I cannot unmute him directly from here. He needs to do it himself. Wait 1 second. Yeah, guys, he's activating the microphone, Freddy. I don't know why, but WAP cannot recognize the microphone that you use. Make sure he's not muted in the system settings. No, it's not. It's not. The problem, guys, I talked with him. The problem is that, wait 1 second. So guys, the problem is that the WAP system is not recognizing the microphone of Freddy. So now I will enter in Zoom with him. I will troubleshoot it and fix it. But you can see the screen with the gamma exposure presentation. Okay. No, it's not this the problem, Nicolas. It's not that this the problem. Is that it cannot, the browser cannot recognize the microphone. It's not this that you are saying. Okay, so we fix with him. I enter in a Zoom with him. I keep this open, and then we join.
Oh, got it. Working. Jesus, thank you so much.
Fix it, guys. Okay, Freddy, can you hear me? Now you can share the screen. You can go.
All right, here we go. Blood, sweat, scalping. Okay, Fabio, can you hear me?
Yes, I can hear you. Welcome to the stream, Freddy. This was the most anticipated and waited, and the people were crazy about the masterclass of the option flow. So today we will go 2 hours with Freddy with the basis, and then we will have another
Can you hear me, Fabio?
session next Tuesday. Okay, go.
Hello, can you guys hear me? Fabio, can you hear me? Oh my goodness. Okay, I cannot hear Fabio. Let me see. Oh dear. Set output. Okay, got it. Bill. Fabio, can you talk please so I can...
Yeah, I'm talking, Freddy. Probably you. Can you hear me?
Yes. So it's working.
Let's go.
Okay now. Right. So let me know when you guys are ready.
They were waiting from weeks from the moment I introduced you to the community. They want to understand how to use. And guys, let me be honest. I've seen a lot of stuff in my career, okay? Indicators, order flow. But what you can get with the option flow, what Freddy showed me, it's crazy. It's mind-blowing. I'm testing this area and this framework to determine bias, and it's fucking insane. So take your time, Freddy, to explain 2 hours today and probably 2 hours last week. This masterclass is what everyone, included me, were waiting.
Amazing. All right. Fabio, thank you so much. First of all, thank you so much for having me. And I say hello to everyone in the community. Honestly, guys, you're very lucky to be with Fabio. You know, I'm coming from the institutional world, and I've seen what's happening in the retail world. And honestly, guys, you are with the best. So Fabio, it's an honor to be here. Thank you so much, and thank you for the time we've been working together. Fabio's been working until 9 p.m., 10 p.m. some days. I woke up at 3 o'clock in the morning sometimes because I'm in Colombia and Fabio is in Dubai, right? In Dubai. So anyway, right, guys. This is what we're gonna do. It's a complex topic. It has a lot of maths behind. So what I'm gonna try to do is today, hopefully 2 hours or around 2 hours, I'm gonna try to explain that maths and what's happening behind. No worries, it's not gonna be a deep maths. But what I have seen so far is people who comes to trade with Gamma, they don't understand what's happening behind, right, the scenes, and they try to trade the levels without knowledge. I think I have coached more than 400 traders in Latam, you know, Spanish speakers, and I always found the same issue. They try to come and trade without knowing what's happening, right? What's really happening, and that's what I create this special presentation for you guys. It's hopefully going to be like 4 to 5 hours. So today we're going to start with understanding Gamma and understanding why this is moving the market, right? And next week, we're going to learn how to use Guestbot, which is the Gamma platform I'm using to kind of read Gamma, okay? So this is a special, and I'm very happy to present it to Fabio's community. All right? So before I start, I want you guys, please don't believe me. Please challenge me in everything that I say, okay? Please question yourself, ask me questions. Don't believe what I'm gonna say now, because that's the basis for everything. I'm coming from an academic background, and I'm here trading Gamma because of that, because I question everything, and until I have proof, all right, I'm not going to believe anything. All right. So for me, trading Gamma, sometimes when I go on trading, not sometimes, every day, for me, it's like sitting in a poker table, right? Because I have to see what the market maker is doing, but also I have to think what the institutional is doing, right? So I see the institutional putting big money in the market. Then I have to, with the knowledge that you guys are going to get today, I'm going to kind of grasp what the market maker has to do. And then I have to think of the other players. They know what the other institutions are doing and what the market maker is doing, right? So this is like kind of, for me, it's like playing poker. I have to be very, very tactic to see all the flows, what other participants are doing, and what the market maker is doing, right? So this is not to change the way you guys trade. What I have found with Fabio, and I was studying order flow before, is when you mix order flow, the knowledge that you have with gamma exposure is going to give you a tremendous hedge. Honestly, it's going to give you an amazing hedge, and I've seen it already. So what is guess is an structural reading of the market, right? And we at GuessBot, with the guys who create GuessBot, which is actually a futures trader and an options trader, Jans and John, we have developed some trading strategies around gamma. And with Guess, it's just amazing. So Guess help us to understand options positioning. And this is very important because we will see it with data later on that the massive amount of options every day, they come into the market, not because they are looking for the stuff of the traders, not because they're looking for liquidity, because they have to. They're forced to do it in order to hedge their portfolios, right? So then the dealer is coming, then we create the gamma exposure. We're gonna learn to see the market in terms of volatility, liquidity, and price behavior, okay? So I'm gonna leave this, Fabio, I'm gonna share with you this presentation, so feel free to share it to your community. And I
Yes, of course.
guys to go to Squeeze Metrics, where you're gonna have time. This is very academic and very mathematical kind of documents, but please go and read it because this is gonna give you the foundation of everything, okay? Now,
We have in the community, Freddy, some market researcher and people that are building dashboards. So I will give this document to some nerds, and they will summarize everything. Also, before starting, Freddy, tell them a little bit about your story, because your story is astonishing, and we don't see a lot of people that come from the institutional space in the social media, So the story about the activity of the market making. Before you, I didn't knew anything about it. So if you want to tell a little bit about your story, I think people will appreciate it a lot.
Yeah, thank you so much. Thank you. Right, we'll do. We'll do. It's coming in the next slices. But before that, what we're gonna do here, we're gonna study the financial options, and as I said before, as the main driver for indices and futures. And this is what I'm gonna try to teach you here today. And for me, it's very important. What I was saying before, what I have studied before, and luckily for myself, when I met Fabio, and he was very open, very kind to reply my message, is this is how I see the market. You guys are surfing the waves. You go to the beach and you guys are surfing the waves with Fabio. And that's fine. You guys know how to do it. Fabio is an expert, okay? But imagine you know how the wave is created. You know that the winds are coming from south to north. You know today is going to be a big storm, so you say, I'm not going to surf today, or that today is going to be a perfect day for go to surfing. So when you go, this is gamma, basically. This is gamma exposure. Gamma exposure, when you go with Fabio, you surf the waves, you got your strategies, but when you study gamma exposure, you kind of study who creates the waves, who creates the weather conditions for these for us to be able to surf. So for me, when you combine order flow with gamma exposure, that's the key to decode the markets. And that's what I'm saying at the beginning. You guys are very lucky to be with Fabio. Honestly, I've seen so many gurus in this retail world. I'm scared. And that's why I try to do this. I try to explain gamma and try to tell people this is how you move the market. It's not a moving average, it's not an RSI, it's not MACD, it's an institution, that came into the market, right? And they moved the market. And what we're gonna do with gamma is to exactly know when they come into the market and how they move the market, so we can take advantage. And I'm gonna show you a little bit later on some of the Fabio's strategy, how we can combine with this. But as I say, Fabio, this is me, and I'm very, very, it's an honor to be here. My name is Freddy. I'm from Colombia, but I have a dream. Many years ago, I wanted to be an institutional trader in London or New York or Hong Kong. and everyone laughed at me. I was in Colombia. I don't even speak very good English. But anyway, so I went to Australia, and I did my first master's degree. And in Australia, then I worked as a teacher. I was teaching financial models in Visual Basic and Excel for 6 months in Griffith University. They hired me because I was the 10% of the best students in the whole university, not only finance. So the professor on that subject told me, like, Freddie, I need some help. It's like now with Gamma. Everyone wants to know Gamma, and there are not many teachers. So at that time, I was the only one. I was the first in my class on financial modeling. So I was teaching financial modeling in Griffith University. Then I got a job as a broker in this company, the Tricom Equities in Brisbane. And everything was fine. Everything was perfect until financial crisis came, and I lost everything, literally everything. I lost all my money. And like you guys see in the movies, you see the guys getting from the office with the carton box with all their belongings. It was like that for me. And it was very unlucky because I was lucky, to be honest. Everything happens for a reason. So with that experience, I thought to myself, this is not going to happen to me anymore. I'm going to get even better prepared. So I went back to England, and I did a second master's in science, which is called International Securities and Investment Banking in this Henley Business School. And that's a master's degree for traders, risk managers, and financial engineers. And thanks to that, I got a job as a market maker or institutional trader in Rabobank in London. And then I did some algorithmic trading in Oxford University, and also with this Quant Institute, which is in Hong Kong. But the funny thing I want to say, and I don't want to spend much time here, is when I got the job at Rabobank, my job was to cover traders around the world. So I had to cover traders in New York, I had to cover the traders in London, and I had to cover the traders in Hong Kong. So then I was thinking to myself, Jesus, that was my dream. My dream was to be an institutional trader, London, New York, Hong Kong, and now I'm doing it. So I just tell you that, guys, because, if you have a dream, just keep working hard, because really dreams come true. And now my dream is to, to be a retail trader and live on the teach this and, make lots of money, make millions of money in the markets. So anyway, guys, so for me, this is the market. The market is a puzzle, all right? So this is the puzzle everyone has been trying to solve for years with moving average, RSI, all these indicators. That doesn't work. So what we're going to do here, we're going to try to solve the puzzle. And this is the most important part for today, okay? So this is how the market moves. And I after 12 years of working as a market maker and now a retail trader, I understand this. So I'm going to go step by step. So how the market works, really. Institutions, they have an incentive to come into the market. They are forced to come into the market. It's not because they want to go for your stock or because they want to find liquidity. No, they have a lot. Think about it. For instance, a pension fund in the United States, trillions of dollars in a pension fund. If something happened, like just what happened in the last months with, Trump doing this war against Iran, they are not going to go and sell their shares in S&P or wherever. What they have to do, they have to come into the options market to hedge their portfolios. So options, if you want to think of options as something easy, think it as an insurance, right? If you have a car, you need to buy insurance. If you rent a car, you need to buy insurance. So if something happened to your car, the insurance company is going to pay, all right? So this is options. They are insurance. So these guys, which are very sophisticated traders, they are, honestly, I work in the industry, these guys are crazy. So basically what they do, they come into these indices, right? And they trade options to hedge their current portfolios, right? So they can do long calls, short calls, long push, short puts. Options is the best instrument to do it. So they come here and In the middle, there is the market maker that you guys probably hear about. So this was my job in London. So as a market makers, we have a mandate to provide liquidity to these guys, right? We always have to say yes. I want to buy this. Yes. I want to sell this. Yes. Right. So we are not allowed, or we were not allowed to say no to these guys. So that's where something interesting, because what happened? We have to take all those flows and we put those flows in our portfolios, in our warehouse, right? We don't win, we don't earn the money by going against these people, right? We earn the money by earning the spread, right? By charging that spread. And we are not allowed, or we were not allowed to go against these guys. Imagine, I don't know, imagine James Simons from Renaissance Technologies, they buy a call from me. Who am I to go against that guy? That guy must know something, so I cannot go against these people. But as we're going to see later on, by providing liquidity, these guys are running literally unlimited risk, right? So the risk is unlimited. And just to give you an example, how important is this? In my job, if I didn't hedge my position, I could have got to jail. First of all, they take me to jail, then they charge me for millions of dollars. So that's how important and sensitive is hedging, what these guys has to do in the market. Okay. And I saw some of my colleagues, honestly, some of the guys, senior guys, I saw them getting out by security, by the door, by the back door in the building. So
That's crazy, Fred. It seems like a movie scene.
Basically, it's like movie. And I didn't tell you when I was a broker in Australia, that was like the Wolf of Wall Street, and I didn't like that, to be honest. I didn't like that environment. I like what I'm doing now. But anyway, so this guy is running lots and lots of risk, right? Unlimited risk. So what they do in options, and I'm gonna go deep into this, but there is something called the Black-Scholes formula, and they comes the Greeks. So basically, the most important Greeks for us is delta, gamma, beta, and Sharpe. And why is important for us as a traders? Because these market makers, they use these Greeks, they are coming from this Black-Scholes formula, and basically these Greeks tell them, listen, don't worry, as long as you are delta zero, I'm gonna give you some mathematical formula, and you need to go into the market and you need to buy and sell futures. When you buy or sell futures, you're going to be delta neutral. So we're going to give examples to be very clear, but just to get the context, these guys move trillions of dollars daily. And if they have to go into the futures market because they need to be delta zero, they're going to hedge, they're going to move the market. They're going to put millions and billions of dollars in the futures. And I don't know if you guys know Sam Carson. He's a legend of this. I mean, he's the guy who knows more about options in the market. He's basically talking about how the market makers move the market. So I gonna please, Fabio, remind me at the end of I didn't put it here, but I'm gonna give you a YouTube video where they explain in more detail how the hedging is doing. I'm gonna do it here, but how Sam Cardan explained it, right?
Yes.
But anyway, so my job, and I told Fabio, was to keep my delta zero. And when I was a trader, derivatives trader, I had the book for euro sterling, euro dollar in the FX space, and I told Fabio, some days we have $2 billion in derivatives, $1.5 billion in derivatives. So as long as we put delta zero, we were okay. But what we have to do, we have to go to the spot market, and Sam Cardan, that's the one, William. And we have to go into the futures and to the spot market and hedge our exposure. And honestly, we move the market sometimes. And for next Tuesday, I'm happy. I'm not happy. I'll try to put my ego down, but I'm gonna show you. I moved the Euro Swift market. I put like $2 billion. I sold 2 Euro Swiss market, $2 billion, 2 billion euro, 2 billion euro Swiss, and I moved the market like crazy, and I make a lot of money out of that. But it's not because I'm telling you this, because it's not because I wanted to do it. It's not because I wanted to establish a position. It's because a big client came to me, gave me derivatives, and I have to go into the spot market and be delta neutral. So at that moment, I thought, Jesus, that, and I'm sorry I called Jesus, but that would be nice if I knew, if I knew what the market maker had to do in the spot market. That would be amazing, right? Because at that time I thought like all these supports, levels, they're gonna go because I'm coming here with 2 billion euros. I'm gonna break all the supports. But anyway, this for me is decoding the market. This is when you decode the market. This is when you understand this now. And as I said before, you guys are so lucky because at the end of the day, you are here with Fabio. Now you know what's happening. Now you know who is creating the waves, the weather condition. Now with Fabio, you establish your strategies. You do what you've been doing, but you're probably gonna run your take profit even more because you know there is a gamma level which is attracting the price, and I'm gonna explain it later. You see, so that's how I think you can combine this with what you learn from Fabio. Or probably you want to take a position, but you know there is a big wall and price is gonna go to that wall and it's gonna come back. So probably you say, you know what? Let's say NQ is leaving the value area high, but guess what? I got a cold wall and the price most likely is going to reverse. So I'm not taking the trade. Okay. So this is how Gamma can help you with this. But anyway, just to go into the market makers, what's the main function? The main function is to provide liquidity in options. They buy when the institutional sell. They sell when the institutional buy. You see, the thing with options is you can buy options, but you can sell options, right? And the market maker is all the time providing that liquidity. And there are no speculators, right? There are no fortune tellers, right? They just provide liquidity, okay? So with the guys from GuestSpot, we believe, and I've been trading Gamma for the last 2 years or 3 years, that 70 to 80% of the moves that we see in the futures market are given by the market maker, okay? So just for reference, the biggest ones are in the index space are Citadel Securities, Sequoia, Jan Street, Optiva, IMC, and Wolverine. They are the biggest ones in the market. And as I said before, I thought to myself, now, wouldn't it be nice to know in advance, and this is very important, in advance, when the market makers exactly trade millions of US dollars in the future market? That would be amazing to know. But now we can do it with the Gamma exposure, okay? Hola, Rafa, saludos. But now, as I said to you guys, don't believe in anything. Maybe no. I don't do level 2 because I don't believe in level 2. Because I think everyone can put a limit order and they can take it out. I used to do it. I used to put limit orders for 200 million. And as the price gets closer, I withdraw my limit orders. Nothing can stop me to do that. So that's what I don't believe. Probably I'm wrong because I'm not, I don't know. But
we saw it live, the spoofing, Freddy, that they put huge wall of order, and seconds before the market reached, they remove thousands of orders and the market collapsed. They do this market manipulation really often.
Yeah, because probably someone who has a short position and they want to scare the market. But listen, we're gonna see this when an option guy and Fabio knows, and we're gonna explain the why we trade NQ, right? We have to follow the NDX. We're gonna follow the NDX index because the guys with big money come here. They don't go to the Qs. They come to the NDX. And two of my best traders trades this week, I saw a guy put in 500 million in NDX, and the market went, like magnet. It went to that price, and it has a mathematical logic. which I really want to explain you guys. Try to do it in my best way. But anyway, guys, everything is legal until you get caught. Yes. What's happening and why you guys don't have, you have to question myself. Yeah, Freddie, why you say that, why you say that options? This is the data for the CBOE, right? The blue, very easily, the blue is the options, the amount of equity options, okay? And this is the projection for the next year. The purple one, or the pink purple, is like futures. So can you see the difference between how options are increasing in volume year by year, but the futures no? Futures are instrument that we or market makers like to hedge, but look the amount how the options are increasing. So I like to be graphical and stuff, but if I put it in a wave, these big waves are the options flows. This is the money that daily comes into the market. The futures are here near the shore, and the stocks are the beach. Okay. So now you guys have started to kind of solve the puzzle. Okay, this guy, market maker, he needs to be delta. He needs to hedge his risks at all time by trading futures. And if the amount of flow that he gets from the options market is that huge, 100% of the time he's going to move the market when he trades, right? When he tries to hedge his exposure. Now, before we continue, we have to keep in mind a few key concepts. The concepts, sorry. The first one is we trade in futures NQ, which are a derivative from the index options, right? Which is NDX or QQQs. So the institutional guys, the big guys, they use options as an insurance, right? Because they're the hedging instrument for the current portfolios. And I put this one here as an example. This is JP Morgan. They have a hedge fund. Every 3 months, at the end of the month, end of March, end of June, end of September, and end of December, the last day, they come and hedge roughly 22 billion in notional value of the portfolio. So they have a portfolio of 22 billion, and they have to come into the market, and they create this, which is called a collar. This is a collar in options. And to show you how clever they are, they have a 22 billion SPX portfolio. So they need to hedge in case the market goes down a lot. So when they sell options, they get money, they get credit. When you sell an option, you get money for that option that you sell because you are providing liquidity, okay? So let's say, I'm gonna put a number because I don't have it in my mind right now, but they need to buy a put. Don't worry, I'm gonna explain a put later on, but they need to buy a put. So if the market goes down, is the insurance. So the put is gonna pay that money. But probably the put is going to cost them $1 million. Okay, so what they do, and that's what I say, these guys are very sophisticated, very clever. They go into the top of the market and they sell a call. When they sell this call, they get paid $500,000, right? Then they go to the bottom of the market and they sell a put. So basically, when they sell this put, they get another $500,000. With that $1 million, they go into the market and they buy a put. So basically, how much money costs them to hedge the portfolio? 0. And they actually hedge. So you see how clever they are? They are absolutely clever. They just nothing. And for us, what's important for us? This day is a day that you see most likely a trending day. You see the market going up and up and up and up. And when you want to sell, it keeps going higher and higher and higher. Why? Because these guys are hedging 22 billions in options, right? And then the market maker, who is the one providing this liquidity, the market maker needs to go into the futures market to hedge this. So obviously, with that information, you say, okay, so what's here for me? And trade and Q, why is this important for me to know? Yeah, it's important to know because these guys are going to put a lot of money. Usually they do it in the afternoon after lunch, and that's going to move the market, right? So if you have a mean reverting strategy, don't do it, because as Fabio, I always quote that Fabio told me, there is a train coming. It's a train coming, and you want to stop the train. Don't do it. All right. So that's how important it is. Now, we understand that institutions use options as an insurance and as a hedging instrument. Now, what we need to do is understand market, not as we've been learning or not learning, but understanding that we need to go up because, or we need to buy because the market goes up, or we need to sell because the market goes down. We need to see the market in the same way that these options guys do it, and it's like expressing in volatility space, right? So we're gonna learn how to read this volatility space. And when you think and learn, as we're gonna do it, that institutions, they don't trade direction, they trade volatility, right? They buy volatility, they sell volatility, and that buying and selling of volatility is what creates the market moves. Remember this slide? When they buy and sell volatility is when they create the waves in NQ that Fabio is helping us to recognize and trade. But now we have a little bit more of knowledge of how they do it. And I put this slide here because this is what JP Morgan is doing. You see, they keep hedging. They keep hedging. They keep hedging their portfolio every 3 months. Okay. So this is very important for us to know. And we need to know what volatility events are important, because that's going to save us a lot of money, or it's going to help us to make a lot of money. Okay. Now, it's okay, Fabio, if we can answer some question, if people have some questions so far, or
it's amazing, Freddy. How is it going till now, guys? One in chat. The alarm of Freddy was to open the 2 billion. It's time, Freddy, to hedge.
It's time to hedge.
For everyone, it's clear. They are enjoying. Are you enjoying it, guys? This kind of content is not the typical content you find in the social media. Yeah, they like it. Let's go, Freddy.
I think someone in the community went to Henley school as well, because when I mentioned Henley, he was like, "No way, Henley."
Yeah.
College. Anyway, I don't understand why the option flow has to move the price. Okay, don't worry, we're going there. This is where we're going now. So now, I that's what I've seen. This is gonna be a lot of concepts that hopefully you guys are gonna review the video. But now we're gonna see deep how the market maker is moving the price. Okay, so this is what we're gonna do. So as I said before, market maker needs to be delta hedge, which is called the first order derivative. And as the price move, because the price is not static, right? The price is gonna move. There is a second order derivative called gamma and charm. Gamma is the most important for us, and don't worry, we're gonna explain everything, but gamma is very important for us, and that's why it's called gamma exposure, because we need to follow this gamma, and guess what? It's gonna organize this information for us. So we just need to learn how to read it. But then is a second order derivative called charm, which start to take effect after 1:30 p.m. So gamma is from 9:30 to around 11:30 midday. It has its biggest impact, but then market maker needs to look charm, okay? And just to give you an idea, gamma is telling the market maker, you need to hedge, you need to buy a certain amount of money based on the move of the spot price. But charm is telling the market maker, now you need to go into the futures market because the option is going to expire at 4:30, and now time is called time. The time is going to be more important than the spot. So time is going to be charm dependent. Charm is time dependent. Okay. So this is the delta. This is the profile of a delta, the blue line, and this is what the market maker is looking. The market maker is looking the delta, and we have to calculate the slope. When we calculate the slope, and this is math, I'm not going to get you into there, But this slope, the calculation of this slope is the second order derivative gamma. For the market maker is the amount of money he needs to buy or sell as the price moves up or moves down, okay? Sorry, I have to put it this because I really want you guys to understand where it's coming from. I'm not here to tell you lies. Everything has a mathematical proof, and this is the mathematical proof why gamma, second order derivative, is so important for the market maker, okay? Now, this is the delta profile of a call of a put. From a put goes to -1 to 0, and from a call is a positive 0 to 1. Don't worry, you guys don't need to kind of get deep into that. What's important to know for us is if you see the blue line, this is when we have 5 hours from the option to expire, right? So let's say it is, I don't know, 10 o'clock in the morning, and we know we have until 4:30. So those options are going to expire at 4:30. So this option has 5 hours to live. But look what happened to the curve as we get close to the expiration. You know, this is 5 hours, the blue line. When the option has 1 hour, it gets steeper, right? This is what happened with the delta. What does it mean? It means that in order for the market maker to be delta neutral, it needs to hedge more aggressively, okay? And I've seen some guys, they have Guestbot or any other service. They will see that at the end of the day is crazy. There's so many flows coming into the market. But is this guy, market maker, buying and selling the futures market to be delta? Now, when we're very close to expiration, which is the red line, look what happened. You see? Gets totally vertical. And that is basically telling, if you go back here, what's the gamma? Gamma measures the slope of the curve, and gamma translating to dollars is the amount of money that the market maker needs to hedge. So as we get close to the expiration time, 4:30 p.m. in New York, market maker has to be more aggressive. And as the time gets closer, market maker needs to be more aggressive, okay? Now, why this works, and you guys, I think we are very lucky because this start to make sense after 2021, right? Before 2021, we were not able to trade 0 DT options. People were able to trade 1 week options, 3 week options, 1 day options, but no 0 DT options. And what's important, if you see the total volume, 970 billion traded to 2025, look the amount of volume 0 DT is more than 0.5%, more than 50% of that volume, right? So just to give you, if someone know options, you can trade options 1 day, 2 days, 1 week, 1 month, 3 months, a year. Every day, around $1 trillion coming to the options market. Keep this in mind that more than 50% are 0 DT, which means options that opens at 9:30 in the morning and expire at 4:30 in the morning. It's like you rent a car and you buy an insurance for the day. When you return to the car, that's it. The insurance has gone. That contract expired. It's no longer, right? So, but for us, NQ traders, day traders, this number is important. More than 50% of the daily volume are 0 DT options, right? Actually, 59%. Now, only 2025, we have 3.9 million of contracts traded every day. And out of those contracts, 59% were 0 DT. So please keep that in your mind because this is very important for us. Now, I'm going to explain how are the mechanics and why this work, okay? Questions so far, guys? I know it's a lot, but I'll try to my best to try to explain it. Freddie, one of the biggest criticisms that I hear about guys is that when market makers hedge, they could be hedging position in other stocks, not necessarily index options. Right. Listen, I'm going to reply that very quickly. The Black-Scholes formula, which we saw before, is a formula for pricing options, okay? Oh. That formula, I'm not going to put it here, but that formula takes into account interest rate, implied volatility, so on, so on. They put some derivatives in the middle, and some there, they have the spot price, okay, or what we call the underlying price, right? So if a market maker get a big flow on NDX, right, like we've seen, and I'm going to show you later, 500 million probably, and I need to hedge my exposure, I'm not going to go to buy Apple to hedge. I am not going to buy Meta. Why? Because my flow was NDX. So what's the derivative from NDX, which is very liquid, and I can buy thousands of contracts all the time? NQ, right? So NQ is my underlying. NQ comes into my formula of pricing options. So if I need to hedge my exposure, I'll do it with NQ. I'm not doing it with anything else. Actually, guys, are you seeing my presentation? In Excalibur?
Yeah, it's all visible, Freddy. You are in call puts market making hedging mechanism.
No, but you see what I'm writing on Excalibur?
No,
Yeah.
we see the presentation that you
Hang
prepared
on.
in Canva. You
No.
need
1
to stop
second.
the share and share again if you want to do the
Yes.
Excalibur.
Oh, amazing. Thank you. Hang on.
Right now,
Sorry, guys. I'm new to Excalibur. Okay, here we go.
now yes.
Okay, let me do it again. Sorry. Sorry, guys. I'm new to Excalibur. I was introduced by Fabio, so it's an amazing tool. Again. Let me repeat that so I can show you, because I need to show you this. So listen, guys, again. Yes. When you're saying hedging is basically moving price to cover yourself, yes, Tom, that's you getting it. So look, this is the Black-Scholes formula again. So the Black-Scholes formula has many inputs: interest rate, implied volatility. We have derivatives of derivatives, etc., etc. And somewhere we have the spot price, right? To price this option. This is an option, okay? So if someone comes with a big flow of NDX call, which is an option, and I need to delta hedge, I'm not gonna go to buy Apple shares to do this, or Meta to hedge my delta. I'm gonna go to where? To NQ. Why? Because futures are liquid. I need a liquid instrument that help me to quick get access to liquidity and hedge my portfolio. So I'm not gonna go anywhere else, but I'm gonna go to NQ to hedge my portfolio, to hedge my risk. Okay. So and that's what I'm not going to anywhere else. I'm going to NQ. It makes sense. It doesn't make sense to mix apple with pears, apples with bananas. If my formula says that I'm creating this option pricing and I'm selling these options because I'm taking NQ within my formula, when someone came to buy NDX to me or QQQ, I'm gonna go to the NQ market, to hedge myself. All right. So that's what happened in reality. That's what people or the market makers do, right? And that's how and why it's so important for us to understand that. And now we're gonna try to get deep into what's happening with the market. Why when market makers, when they provide liquidity, why they move the market? And it's very simple, right? So look, this one on the top, let's say this is a client who buys a call, right? So if you see here the P&L, right, and on the bottom you see the strikes, you see when you buy a call, when the client buy a call, what he's expecting the price to go up. So basically he buy a call with the strike here. I don't know. Let's put a number. Let's put 28,000. in NDX, okay, and the price is here, what happens? This guy is expecting the price to go up, okay? So he buys a call. He pays something which is called the premium. Let's gonna put a number. He pay $1,000 for the premium, okay? Why? Because he's hedging his portfolio, he's hedging something else. This is the insurance. You rent a car and you have to pay a small insurance for the car, right? If the price go higher, fine, he's gonna start to make money all the way up, right? So he's starting to make money from this call, okay? But if the prices stay lower, if the price doesn't cross this strike 28,000, he's happy because he just bought an insurance and that's it. Probably he was hedging something in his portfolio and that's it. Price didn't went there. He paid a small premium, probably to hedge a $1 million portfolio, and that nothing happened. It's like, again, when you rent a car, okay, when you rent a car, you know, you return the car, nothing happened, okay? Nothing happened with the car. So this guy is happy to pay this premium. But now, what happened with the market maker? Remember, market maker provides liquidity. This market maker, he sold the call, okay? He sold the call to this guy, okay? Now, can anyone tell me what's the risk of the client? Someone told me to use this, which is, so here we go. The client pay a premium of $1,000. So this is negative. Actually, let's put a negative sign because the client pay for this and the market maker actually, he charged $1,000. But what's the risk for the market maker? Taylor say unlimited, and Taylor is right. So look, the risk is unlimited. As the price move higher, right, move to the right, the market maker is losing unlimited amount of money. He could bankrupt the whole institution, right? So now, remember the delta zero? So the Greeks tell him, hey, listen, don't worry. I know you have an unlimited risk, but as long as you're delta zero, okay, you're going to be hedged. So how I get the delta zero? Remember, I go into the futures market, and guess what? I need to buy futures to hedge. And that's going to be this line here. All right, this is my first buying of futures, NQ. And you see is the x-axis is a strike, it's underlying price. I'm talking about option. Someone say x-axis is in strikes. I'm talking about options. So I'm doing everything on options terms, okay? But it's the same thing. You can put prices here, doesn't matter. Prices for NQ and strikes for options. It's the same thing, guys. It's no difference. What I'm trying to show here is what's the risk of the market maker. Oh, I'm sorry, I forgot. I need to put this on. Okay. We can put here NQ prices or NDX prices, doesn't matter. And these strikes are for options. What is important to you guys to understand is that the market maker needs to buy futures in order to be delta hedge. Why? Because if the price is going higher and the option, he's losing a lot of money on these options, you see? Every time the market goes higher, he's losing money. But because he bought NQ, he needs to buy NQ and he's winning. So basically, the net effect is a line like this, which is basically zero. Here we go. You see, this is my delta hedge. This is when the market maker has a delta hedge of zero. Doesn't matter if the prices goes up, because as he buy NQ futures, he's going to make money in the futures, and he's going to cover the losses that he has in the options market. Okay? So that's the mechanics. That's why when the market makers get a big flows or get flows the whole day, that's why he needs to go to the NQ and buy. Okay? He needs to buy futures. Now, let me delete this. This is delta hedging. But remember, now the markets, they are not static. The markets move. Let's say the market was moving this, and let's keep going higher and higher. Okay? So as the market moves higher, guess what happened? Delta, which is represented by this bar, it says, hey, listen, I used to be delta zero, I used to be delta neutral, but now I'm not, right? Now I am a negative value. I need to be delta zero. I need to go back to delta zero, okay? So guess what happened? The market maker has to go. So he goes into gamma. He have a look gamma, and gamma say, all right, you need to buy 100K, sorry, you need to buy 100 more thousands of dollars worth of futures so you can be delta neutral. Let's put it large, okay? So what's the market maker doing? Well, he needs to go into the market. Let's put it in another color, and he needs to buy more NQs, okay? And as the market goes higher, guess what? He needs to buy more futures, okay? And that's the mechanics. That's kind of the simple way to understand why the options move the futures market and moves the market in general, all right? It's just the market maker hedging their exposure in the market. It's nothing else, and they need to do it. And this is what I have to do it when I was in London, all right? This is what I have to do it. Now, this is the other side, okay? So this is a client buying a call, and this is a client selling the calls, which is the same. When a client sell the call, because they do it, right? They also do the sell the call. So who is the buyer of the call? The market maker, okay? And what does the market maker needs to do in order to hedge this portfolio? He needs to go into the opposite direction, and he needs to sell NQs, okay? Obviously, this is now everything start to make sense, because if you think about it, okay, let's say I go $1 trillion in daily options flows, right? But guess what? Now, let's put it green. $500 billion of those dollars, right, are 0DT options. So options that the market maker need to hedge very quick, okay? Very, very quick. And we are going to explain mathematically why he needs to do it very quick, okay? He has no time to think about it. Now, the other part, I'm sorry I'm going this a little bit fast, but I guess you guys get why what's happening. Now, the client can buy a put. And this is what we saw when we start the war with Iran. Everyone was panicking. Everyone was buying puts, right? And the market maker was doing, the market maker was selling the puts. This is the profile of a put for the client, and this is the seller of a put. So imagine, God forbid, but imagine the third war started and it's a nuclear war. Can you imagine where the stock markets are going to go? Are they going to go south? And the risk for the market maker is unlimited. Unlimited. He could lose everything. So what the market maker has to do, he has to go into the market and what? Sell futures. Which futures? NQ. Well, I'm talking about NDX. If we are talking about SPX, he most likely go and sell ES futures. Okay. This is NDX. So, or QQQs. So when the guy buy puts because the market is in stress and he needs to cover, look, if the market goes down, south, the client is going to make money on this put, okay, because the market is going lower, but the market maker is going to lose a lot of money on the put. So the market maker say, okay, my delta tell me I need to be 0 delta, so I'm going to go and sell NQ futures. So if the market goes down, I'm going to make money on the futures, and then I'm going to be delta neutral. Here, I'm going to be all delta neutral. Okay? And if the market keeps going lower, I'm going to sell more futures, because my gamma, remember the second order derivative gamma, is telling me I need to sell 100K more, 200K more, etc. Okay? This is, in a simple terms, the mechanics. Why do you go to the left on put? Because when you buy a put, someone is asking, why do we go to the left on puts? Because when you buy a put, you're buying an insurance that when the market goes down, you're going to make money. So in futures, when we think the NQ is going lower, we sell futures. People in the option space, when they think that the market is going down, they buy puts because they make money when the market goes down. Okay? No big WAPs deviation, sorry. Doesn't have to do anything with options. So someone was asking that. I use big WAPs a lot. And the reason I use big WAPs is because at the end of my career in London, most of my clients, they put me orders at big WAP. In the past, they call me and they say, what's your price? And I say, okay, this is my left, this is my right, and they gave me. Now, after the financial crisis, they give everything on big WAPs. So they all we have to do is put money into a system, into algo, and the big WAP did everything for us. So the big WAP was selling, didn't sell. When the price come back, they sell again. So the only let's put it that way, indicator that I use is big WAPs. And also because it has a lot to do with volume, which I think Fabio agrees that volume is everything. And I think your strategies are based on volume profile and when the market get out from that.
Yeah, absolutely, Freddy. Also, guys, consider that I'm trying to bring the best professional I know, and we will have another session in June with a micromechanic expert that explain the alpha execution method. What Fred is explaining is alpha execution. So if you need to put 1 billion, if you execute everything now, you will receive a crazy slippage. What you need to do is fractionalize this order and you can do this either with iceberg or, for example, putting it on the VWAP as average. And there are algorithms that do this for you. So you input the order, then Freddy was doing it, so he knows exactly how this is done. I studied it, but that's the reason the VWAP is a really sensitive level,
Yep.
and the value area of the previous cash session is a really sensitive level. They use these levels to input order. And then I don't want to give spoiler, Freddy, but you know our setup, the AAA, no? That is the maximum delta that you see.
Yep.
I started testing the AAA plus options level. So when you have double confirmation, trust me, it's illegal. But Freddy will explain this later, okay? Probably next week.
Yeah. But listen, just a bracket. When I started working in my desk in London, we were 12 traders. And when I have big orders and I have to hedge, my delta 0, and I didn't want to get caught, I have a bracket. And every market maker has a kind of bracket where they can actually move before they lose money. The spot price move in some bracket before we lose money. So when I started, what I used to do, I used to call Citibank, Goldman Sachs, JP Morgan, and I used to, $50 million yours, $10 million yours. I call my broker, I call another broker, I put some limit orders in my systems because I didn't want to get caught, hedging my exposure, hedging my delta. But when remember, when I started my job, we were 12 traders. When I finished, we were 3 traders because everything went to electronic trading. And everything that I was doing manually was replaced by VWAP systems, So
maybe Freddy, the other traders went to jail.
Well, if you guys look into what's this newspaper? Forgot the name. It's the Financial Times. If you look the Financial Times at that time, what was that? 2020, 2019. They mentioned the cartel of traders. I don't know if you remember that. They were a cartel of traders, and two of the guys were basically my senior traders at the time. And goodbye.
Next level mafia, market making mafia, Freddy.
I always get late to everything. I was late to that mafia. Wouldn't be nice to get to that mafia, to be honest. No, I mean, what it was nice, because those guys were the mafia trying to understand this, right? Now we have the tools to see the mafia. I mean, let's put in brackets the mafia, because we have the tools to see when the big guys are coming into the market. Okay. So that's why gamma exposure is so important. But anyway, let's continue. Otherwise, we're not gonna. So big WAP is the only, and volume profile is the only kind of tools that I use. Nothing like Fibonacci, is nothing crazy like that. I mean, it doesn't make sense to me, to be honest. Okay, guys. So this is basically the hedging mechanics, and that's what happened in. This is gonna explain it later. But this is what happens. This is why the market makers moves the market. They have to. And honestly, with all my heart, I'm telling you the truth. I was doing this for 12 years. I have to. The difference is that I was not thinking of the impact that I was doing in the market. All I was thinking is hedging my position, right? I wasn't thinking of anything else. And at the end of the day, we went to the pub, and I met the guys from Barclays, and I met the guys from JP, and I'm gonna say the F word, but they sometimes they say, "Oh, you know, you in fact you were the one who were selling cable today, and you moved the market." And I couldn't say anything. I just laughed. And in the same way, when I saw them moving the market, I was telling them, "Oh, you moved the market today. You sorry, motherfucker," something like that. But anyway, that's the mafia. That's how institutions. But all I want you to understand, guys, is not these guys trying to look for liquidity or try to look for our stops. They just doing their business.
Freddy. I need to ask you something. Should I ask the question to Freddy, guys? Yeah, let's cover this question. So we have a market maker that did this for a living. Does market manipulation, hunting of the stop loss below the low, above the top exist?
That's a very good question. I don't think, to be honest. What I think that is happening from my point of view is I got a client who give me lots of money to put into the market. Again, not because he wants to do anything bad, it's just because he has to, right? And I am the market maker in the middle who needs to hedge my exposure with delta and gamma. Okay. So
of course,
what I think what happened in the market is, let's say I have to sell a lot of money. So I start to sell, I use big WAPs, whatever. I start to sell, I start to sell, I start to sell. I learned this in a hard way with tears, but sometimes you need to stop the selling and wait for the market to bounce a little bit. Then you start to sell again and sell. Okay.
Yeah.
What's going to happen in the process?
Freddy, but you think that they intentionally seek the stop loss of retail, or it's all bullshit?
No. I think it's bullshit. Listen, this is what I think. So what's happening in the selling process? There is a lot of people with stop losses, right? So all those stop losses are triggered as someone big comes to sell. And again, this is what I used to do, and I can tell you the story later, but I learned this with tears, that if I'm selling a key level, I just stop selling and wait for the market to come back. Because the market doesn't go up because there are buyers. Their market can go up because there are not enough sellers, right? It's just natural. If you don't have a pressure, the market go up. And then you sell again and you sell again. So what happens? At some point, someone with a big position will say, I'm sorry for the F word, fuck it. I need to sell everything because I can't stand it anymore. So when he sells everything, and I am the market maker also selling everything, let's say I finish to sell my $1 billion. Okay. So what happened when I finish to sell the $1 billion? That's it. Market goes like this. Why? Because I'm finished. And someone big also have what is called capitulations. Right? And this is very important because one of the models for Guessbot, which I work with the guys, with my experience, is we see the market going lower, we see the market going lower, we see the market going lower, and suddenly, oh, we saw this, Fabio, with Luca. Remember? Someone say, fuck it, I can't stand anymore. I have a call. Now I need to go. Guys, I'm going to explain this later, but I'm going to go and sell my call. This is order flow from Guessbot. When he sells the call, lose what happened. He takes pressure off the market. Why? Because the selling has stopped, right? And that takes pressure from the market. And we're going to see this with Gamma, okay? Yeah. So it's my point of view. I could be wrong. I don't have the final word, but I never thought about taking, I never thought about retails even. I didn't know what retail was, to be honest. I was like, so I was just doing my job.
You were like peasant retail trader at home with $1,000 account, not even the liquidity to fill the order you have. Yeah. But when you deal with this flow, I think we retail don't make even a 5% of the market.
No.
This was the data in the Bank of International Settlement from Tomogard, and Tomogard was explaining how can institution want the stop loss of retails if the cumulative volume that retail move is 5% of the intraday flow. So they are really small. They move because they have necessity of hedging or other necessity, but it's a battle between the players that move billions. We are also me. I'm a worm compared to them.
No, but you know what is impressive is that you have developed the strategy to serve the ways of these guys when they put that money, and as I said before, they do it in a way that you can predict, and that's the value of order flow. And every day, I listen with Gamma. I gonna show you. I know where the market goes, where it tops, where the market can go on the way up, where the market can go on the way down. And when you combine that with Gamma, it's like, value area low for the first 30 minutes, you go short, and probably you're going to start to take profits because you are scared. But if you have a Gamma level, you are here, and there is a Gamma level here, which is, I'm going to start, this is magnets. This works as a magnet, attracting the price. That's going to help you because you already got the methodology. But instead of I don't do 1, 2, 3 risk rewards, 1 to 2. I go 1 to Gamma because I go to the next Gamma level. I send you my screens, my trading, and I take profits on Gamma levels. And that's why sometimes I go 1 to 15 risk rewards because the Gamma level is so there that I say, it's gonna get there. And if it doesn't, that's fine. I do stop in profits, but when you understand Gamma, it's going to get there. Okay. I'm sorry for my drawing. I'm not as nice drawer as Fabio. But anyway, that's the mechanics. That's why options moves the market, right? Obviously, this is kind of the textbook education, but bear in mind that these guys, these market makers, they also have a portfolio of options, right? It's not only 0DT. They have more options with more expiry dates, but we're going to see why those expiry dates are not as important as the 0DT options, okay? So listen, we're gonna kind of, this is the basic mechanics, right? I promise I didn't get into maths. Oh, sorry, someone asked me. No, I'm not from Spain. I'm from Colombia, actually. Sorry for my accent. And this is one of the models. This is the models that GetBots started, which is called the classic, right? In the classic, we follow the SPX. Oh, sorry, I didn't put it here, but this is the SPX, okay? So if you understand, so as I said before, large institutions, they have to come into the market, but they have limitations and they have incentives to get into the market and out of the market, okay? And this is what is called gamma exposure. You guys are looking my screen, right? The gamma exposure. I just want to make sure.
Yeah, we can see the screen. We can see now, guys. We are getting into practical. Okay, so before we were on drawings, this one it's already GEXBot platform, the platform that Fred is using.
Yeah. So I trade NQ, but I use the SPS as my main map. Not because I trade SPX, but this is the money where most institutions comes to hedge their portfolios, SPX, right? So if you see here, this is what is called the big red bar on the bottom is what we call the big negative gamma, and is the biggest concentration of puts. I'm not going to get into details, but puts, they kind of have a downside exposure. So everyone who wants to benefit from a move lower, they will buy a put, okay? Put it in simple terms. Everyone who wants to benefit from a move higher, they will buy calls. This is a little bit, I know many people don't understand options, but if I also, as an option trader, I want to benefit from a move higher, I'm gonna sell a put, okay? And if the market is going lower and I want to benefit from that down move, I'm gonna sell a call, okay? So this is why options are tried, they have 3 dimensions, and people can do so many ways in options. And they have, like Ofmel said, there are 4 ways, yes. And they don't have 4 ways, they have unlimited ways, because when you combine these 4, buying option, buying a call, selling a call, buying a put, selling a put, you can do unlimited structures in the market. And actually, for the people who trade gamma, there is a guy, I believe this is Goldman Sachs. We call him the Capitan Condor, because at the end of the day, he established 1D positions, which are positions for the next day, with condors. So condors are basically, I'll explain that later, but a condor is a structure that basically the guy for the next day thinks that the market, let's say, is not going to move from these levels. So the market is going to be contained from these levels. And the options guys come with thousands of contracts, put the structure, which in this case is the iron condor, expecting the price not to move from this area. So with that information, what he will do, or what we will do, is, listen, if I go long, I'm not going to expect the market to go higher than this top. All right? Yeah, that's the iron condor, Tyler. And that's it. So this is the kind of information that the options give you. If you go long here and you 1 to 3, but you 1 to 3 is above the level, you know what? You better take profits here, because the market, there is a high probability it won't go higher. And I'm going to explain why it won't go higher in a minute. So as you can see in this example, the price went down, crossed the peak negative gamma, and then it started to go higher. And when it went to the peak positive gamma, it started to go lower. There is a reason for that. There is a reason that happened. And why does the market reverse with high probability at these peak gamma levels? Okay. Why? There must be a reason. It's not only this graph, this bar here. And that's why, sorry guys, I'm spending a lot of time here trying you guys to understand. This is not only like pivot levels. It has a logic. And the logic has a little bit of maths. And I'm sorry, but I have to explain this maths. And go back to Excalibur. Right, what's the logic on the maths? Okay, let's imagine. Let me do this. I'm gonna try to so you guys understand. Sorry, bear with me one time. Okay, let's imagine we have. This is no, apologies. Let me get another one. What? Okay, the one has to be like that. Okay, and now we have the put here, which is color red. Okay, so remember this is let's say this is the peak call gamma for the day, and on the bottom we have the peak. Oh, sorry, I have here the peak put for the day. Okay, so what does it mean? It means that this is the biggest concentration of puts. Obviously, we're gonna have we're gonna have some put levels around here. Okay, and then we're gonna have some call levels around here. But this is the biggest call concentration, and this is the biggest put concentration. Okay, so now let's say this client, which is let me put it here, the client, this guy, this is the client, right? This client bought this put. And remember what I said before, and I know this is a little bit difficult to remember, but this was a guy who was expecting the price to go lower, okay? So this big guy positioned himself at this level, all right? So they go here, and what happens when the price go to this level, right? So basically, it's something called the 50 delta. Let me see if I can write it. So the 50 delta is right at the strike. And remember the gamma, this is the gamma profile, which looks like a normal distribution or Gaussian distribution. Sorry, I didn't write it properly. So what's happening at the strike? Let's say this guy bought this put, so he was expecting the market to go lower. I don't know. Let's say at 28,000 here, NQ or NDX, and he was buying this put at 27, I don't know, 900. Okay, so he was expecting the market to go lower. He bought this put from the market maker. Okay, down the bottom is the market maker. Remember, his risk is unlimited. Okay, so that's what I put the poker table. Imagine you are there watching this client, but you're also watching the market maker, and you're also watching other traders who are looking at this. So what's going to happen on this? What happened when the price get to this level? And to know what happened, or most likely, or there is a high probability, we also need to know something what is called convexivity, right? So options have convexivity. What it means when the options are convex? It means that if I buy this put and the prices start to go lower, I will have my P&L, we have this curvature. To put it in simple terms, if I trade the NQ, right? And from X1, oh, no, that one. From X0 to X1, you know, from this move, from here to here, I made, I don't know, let's put it, I made 1%, or let's put it, what is that? This, sorry. I make, I don't know, I made 10% on my trade, okay? Don't put it in money, let's put in 10%. The guys who trade this NDX option, guess how much money they made? They could easily make 300%. So now you see why so many people goes into the options without knowledge, which is really crazy. So when you trade options, we trade NQ, we make a lot of money, fine. But these guys make 300%. Why? Because options have convexity. It's like kind of exponential. Okay. So this convexity is why so many people go into options. So what happens when the price get to this strike, which is called the 50 delta, as I put it in here? This is the 50 delta, right? So as an option trader, I already made 300%. Guess what? I'm going to liquidate my option, right? I'm going to go to the market maker. I'm going to say, hey, dude, thank you very much for the option that you sold to me. Now I sell it back to you. So the market maker, remember what the market maker was doing? On the way down, the market maker was what? Selling options, selling futures, sorry. So on the way down, the market maker was selling NQ, okay? We're selling futures, right? So now that the price go to this level, right? And I'm gonna put it on this table. So you see, this is clear. Client is making money. Once he gets to the 50 delta, he liquidate his position. Why he liquidate his position? Because various reasons. First, he make already 300%, right? And if you see the green normal distribution, let's put it this way, as the price went to the left, the gamma was increasing, okay? What it means, he was earning a lot of money, right, on the way down. But guess, look the profile, what happened when the price keep going higher, but the gamma profile, now what happened with the gamma profile is going lower, okay? So what does it mean for the option guy? It means that he's still making money, but he's making money at a decreasing rate, right? So if he made 300% on this move, if he measured the same move on the other side, he's probably going to make, I don't know, let's going to put something. He's going to make 100%. So the risk is asymmetric. He's not going to make the same money because gamma is decreasing in time, is decreasing in value. So he's going to make less money. He's still going to make money, but he's going to make less money. And there is something important, which is called, let me put it here. And this is why options have 3 dimensions. And this is called theta decay. And the theta decay behaves this way until 1:30 p.m. So what is theta decay? Theta decay is represented like this. Basically, it's the tax, right? Imagine theta is like the government who charge taxes on the option. So it really, really takes an effect after 1:30 p.m., okay? So after 1:30 p.m., it just increases in value. And what it means that this option is going to decrease in value because it's like this option has to pay taxes on this theta decay. So if I were an option trader, and that's what I mean, sitting in the table, like playing poker, when I see these guys and I say, okay, this guy needs to liquidate his position, most likely, because if the price reverse, if the prices start to go higher, oh, sorry, let me put this color. If the prices start to go higher, guess what? He's going to lose money on theta decay. He's going to lose money because now the same way he make 300%, if the prices start to go higher, he's going to lose a lot of money exponentially. Okay? Yeah, 1:30 p.m. New York time, around that time, around midday, after midday. So if I already made 300%, you know, I'm going to liquidate this position. I'm not going to I'm not going to run the risk unless special conditions we will see next week. But I'm not going to risk I'm not going to run the risk of continue with this option because I got everything against me. You see? So I liquidate the position. I'm going to sell the option back to the market maker. And guess what? So let me make a table here. So this is the client, right? And the client has what? An option portfolio, right? So the client has an option portfolio, and the option portfolio was a long, sorry, it was a long put. Okay? So he has a long put. Now, on the other side, we have the market maker. Yeah? His portfolio was what? He has also an option portfolio, which was a short put, right? So he was the opposite of that put. But guess what? He also has a futures portfolio, right? Remember, he's been selling futures. He's been selling futures on the way down. So have a look at this. Let me put it like this. Let me put it like this. Let me put it like this. Okay. So now, as we saw above, when the price gets to the strike of this client, he will go and say, oh, thank you very much. Now I'm gonna sell my put. Why? So how is gonna be the option portfolio for the client? Well, it's gonna be zero. He's not gonna have options in his portfolio. He bought a put, now he sold the put. Okay, that's it, gone. Now, market maker, he short the put, or let's put it this way, he sold the put now, and now he needs to buy the put. Okay, so how is going to be his option portfolio? Zero, right? But on the futures, which is in this case NQ, let's put it NQ. Oh, right? What he was doing, he was selling. Okay, let's put this one in red. So he was selling NQ, right? Now, what happens now that the price went down a lot and it gets to the put level? Look, zero in the portfolio of options, zero in their options portfolio. And guess what? He's short NQ, millions of dollars of NQ. Now, what he needs to do, well, he needs to say, shit, I need to go and buy NQ. I don't have any more hedging, so now I need to go on quickly buy options. Yeah, and when he buy the options, look what happened with the price. Touch the level and start to go up. This is the mechanics. This is what I believe market makers 70% of the times move the options. Okay, why they move the options? And let me go back to my right now. Why 0DT? Now, you guys remember the 0DT, the statistics, the data I gave you. 0DT are more than 50% of the daily options. So they are huge. There's lots of money in 0DT. Now, this is the gamma profile, if you guys remember. So the red line is 0DT options, okay? Like kind of the blue line, green line, you know, the yellow lines, they are other options. One day, the further the options, the more flat the curve, right? So what it means that I put it in a imagine an F1 driver. He's going this car at 80k per hour. When he's go a non-zero DT options, I mean options from 1 day, 3 days, 3 months, whatever. Well, if he take a curve at 80k per hour, he's gonna do it very slowly, right? He's got time to brake. He's got time to, you know, move the car very slowly. He has no pressure. And for those who are interested, 0DT options, the red one, you see that they are very, you know, that they're very concentrated in the middle. This is called leptokurtic in mathematical terms. This curve is leptokurtic. What does it really mean? Well, it means that in 0DT options, now the driver goes at 350k per hour. And when he's going to a gamma level, guess what? He needs to brake aggressively, and then he needs to start the engine and go 300k per hour to the other side. Okay? So I'm going to show you something. I don't know if this is clear, but this is why 0DT options are so important. We know what the market maker does. We know that he goes into the future markets and he actually moves the market, right? So, and this is the difference why zero DT is so important. This leptocurtic curve is telling the market maker, you have to do it now. You have to do it quickly. You cannot wait. Okay. So I know next Tuesday we're gonna learn how to read and trade with Guessbot. And we also, very important, we need to learn about bull events. Everyone should know about these bull events: triple witchings, opens, JP Morgan color, inspirations, right? So we're gonna talk of them, but this is what we're gonna see next week. So this is the classic, right? And you saw already the classic. When they go to these massive levels, they tend to have a mean reverting trade. So I have a chat with Fabio, and Fabio told me, I prefer, and he's a statistic and studies, he's very good in, go with the trend, and Fabio say, like, going mean reverting, if you don't know the gamma, is very dangerous, because you're gonna sell at this level and the market keeps going higher. You're gonna sell at this level. It happens to all us. I want to sell this rally and the market keeps going higher. And when I don't have more bullets, guess what happened? The market reverse. Okay. But if you know that you have a call wall or a peak call gamma, and you know what this guy is doing, the options guy, then you know what the market maker is doing. Then you kind of think, okay, if the options guys are looking at this, they're going to go and establish short positions, right? So we're going to see this. This is very important for us. We're going to see this because this is a model which is called gamma model from the guys. And this is going to learn us how to trade NQ, right? So SPS is a map. NQ is how we're going to establish positions. And this is what I mean. If you establish a long position here, and let me put it here, right? If you establish a long position, because this is a long trade, because you got the maximum of gamma negative, we're going to see it next week. Look, where is your target? So you go long from 418 and you have a target on 528. So you go like 114 points, which are more than 500 ticks, okay? So either way, you can protect yourself, but if you have 1 to 2, 1 to 3 strategies, this is where you leave money on the table, right? Because you're gonna take your 1 to 2, 1 to 3 around here, and guess where is the big magnet? Where is the money? Where is the gamma, which is attracting the level, okay? So I'm gonna teach you this next week. And also, I'm gonna teach you to read, this is key for gamma trading, which is called the ball skew. And I don't know if Fabio, you want to say this, but one day I was trading with Fabio, the market was going lower, and I said to Fabio, this is not going low anymore. This has to go higher.
Yeah, I remember.
Fabio,
guys, I was like, the IVB was short, the pressure was short, and Freddy was like, no, but we will react long here. So start accumulating position. And I didn't took the short, okay? I closed early, the first one that I had, and then the market reverts from there. So you can understand that also if you are a directional trader, knowing where it's better to take, take $3,000, take 2,000. Don't try to go for the 5, 10,000, because you have a 75% probability, Freddy. How much is the probability of these levels of reversing? Yeah. Okay. Yeah. So this is really helpful. And I will be honest with you guys, I've always been an order flow trader, okay? But in the last 3 months, Freddy is the first person that is making me think about implementing option flow, because I can see the results and the consistency getting better and better, okay? And this is thanks to him.
No, and the thing is, like, listen, is not to change the model, as Fabio say, is to give you some understanding that Fabio was sure because of his model. And I say, Fabio, this is not going any lower because the volatility skew is telling me that options on the downside are very expensive. And in the options world, the concept of expensive are cheap, they are very important. I know futures, what's expensive for futures, Fabio? I don't know. The market keeps going higher, and you cannot say when it's expensive or not. But in options with implied volatility, these dots are implied volatility, you can tell when options are expensive on the downside. So when I see this shape, I say, you know what, I'm going to take profits on my short thanks to Fabio model, but options are telling me price is not going any lower. Prices, I got a gamma level, and options are very expensive on the downside. Instead, options are becoming cheaper on the upside to this level. So now I've been using it with Fabio strategy. You know what? I'll wait for the price to get to my value area low for the first 30 minutes. And guess what? The price get to this level, right? Only by understanding the ball skew. And we're going to see this next week. So we're going to see this convexity. Sorry, my thing is not moving. Percent. Okay. And then, so Guessbot has 3 models to recap. The classic, which we use when we follow the SPX as a map for the market. We go the gamma model, which is the one what aligns for us because we trade NQ, so we can use this information to trade. And we have the order flow, which this one is the most expensive model, but basically, this one is so precise that when you see someone, I'm just gonna give you this example here. I went long here, right? The prices was going higher. If you are long, you tend to take profits. But when you see this short convexity, we will see next week, this is going to be a magnet for the options, right? Why? Because this negative convexity is telling me options are cheap on the upside. So when I look at this, I remember Fabio's model, and I say, okay, if I go my 30 minutes value area, and I see that it's breaking my 30 minutes value area, I'm going to go long until this level. I'm not going to use 1 to 3, 1 to 2. I'm going to this gamma level. And look, we get there, okay? And we reverse here, which is difficult, I understand. And I do agree with Fabio when he say, taking mean reverting trades is dangerous because it's stopping a train. But look, when gamma tells you, listen, that's it. Market for today is not going any higher, you take the short, right? And I think in your model, you have also a mean reverting strategy. And the work that we have to do all together is to incorporate Fabio's teaching with the view that Guessbot or Gamma is telling you. And listen, this is the same. I took this trade the other day. I missed the short, I must confess. And I refused to go short because the ball skew was telling me, options are very expensive. Options are very expensive. All I have to do is wait for the price to go to a positive convexity, which we'll see next time, and then go to the next buy here, put a stop loss below. Options is telling me it's not going any lower. There is a big guy here, NDX. And just to give you a concept, when a big guy wants to enter the market in the Nasdaq environment, they will go into NDX space. Why? Because an option contract here is $10,000, $12,000 in the first standard deviation. The other index who tracks the Nasdaq is the Qs, QQQ, but a contract in the QQQ is $60, $100. A contract in the NDX is $10,000, $12,000. So someone asked me in the chat, why NDX? Because I want this. I want a big guy with big pockets going to the market, telling the market, that's it. This is not going any lower. Look, and the market start to go higher. Okay? And we're going to see it. But when we study volatility skew, we're going to see options as a supply and demand. This was magic. And this is a trade that my colleague too, I didn't took it, but you see this negative convexity at 28,891. The price was 28,152. And someone a big guy, 10:30 in the morning, he established this negative convexity, right? And that's telling me options on the downside are cheap. It's this. It's this ball skew. It is the opposite. So the dots were on the left-hand side telling me, you know what, on the downside, options are cheap. So most likely, or there is a high probability that the market will go to this level, and she established the short position until here. So basically that was 250 points. Jesus, that was like 600 ticks or so. So by reading volatility, right? So this is something that we're gonna do next Tuesday, and well, I think we leave it for there because I don't know. It's been like 2 hours,
Amazing,
right?
Freddy.
We organized 2 hours or so.
No, it's perfect. I would like to see the feedback from the people, guys. I don't know if you understand like that the gamma and the option flow for the last years were something that were really restricted to a 1% of traders now, because also all the people get scared about the mathematics behind and the statistics behind, no? And I build my edge based on directional and based on order flow that is giving me the rhythmic and the timing of the market, okay? But when I start to see that the market 7 times out of 10, when you have this level, reach this level at the end of the day, the first connection that I make is less like how many trades I closed at $5, $6, $7, $8,000 that could have been floating to 50, 60, 70, because I already know, as you said, Freddy, that these are magnet for the price. So it's like if you have a pulling power over your level, no? And this is really different from the concept of guarantee method, easy money. This is something that really works, okay? And that we are treating with a lot of respects to the market, because nothing is guaranteed, because there is risk. But guys, this stuff really works, okay? Really works. And for example, also today, Freddy, I was watching, I will share my screen if I can, 1 second. And I was watching, I only took one position because I was following your lecture, but let me share 1 second here on the screen. We had only one setup from the Nasdaq effort. So what I do, Freddy, I use the IVB as a filter, no? For the direction.
Are you sharing your screen? I can't see it.
I'm trying to share the screen, but it says that you are still active on the sharing. I will try to.
Let me see. How can I stop? That's what I want to stop.
Try to
Stop.
reset.
Oh no! Oh shit! Sorry, I did something wrong. Choose code.
I will share my screen now. First one, and I will go on the settings here. Can you see Freddy my screen or no?
No, I cannot.
Okay, they cannot see. Okay, I will try to.
I'm not sharing anymore. So just to let you know.
Now should be. Let's try now. Now, guys.
Yeah.
Now you can see Freddy. So, for example, Freddy, you know my method. Like we are working together on this to improve. And today we had the first level that I use, that is from the value area low. This is what I consider discount for me. So if the opening range is like this, okay, you can see that in the first 30 minutes of the session, so at 10, we already had a really clear value area low, no? This for me is the first information that the market wants to go up. Then I'm really conservative and I wait for the breakout of the IVB and I wait for a test. Now it's giving another Nasdaq effort area. Okay, I took the position early because I didn't want to like continue the position higher, but I wanted to follow. But you know what helped me a lot today to frame the bias? This one. Because look at this, the IVB, okay, was not, no, this is crazy, guys. This is really crazy. It's like 20 sessions that I'm using it, and 15 sessions, sorry, that I'm using it, and I'm doing a lot of data collection with Luke, no? The IVB was long here, and it's amazing, okay. But the zero gamma was long from the beginning, and the only test that they did was at zero drawdown. Was like this trade here. Was this right here, the only test. So imagine switching from a concept of I wait for the battle of the 30 minutes to have a bias. 2, the bias is the GEX. Because if the wave is created by the market maker, okay, if the wave is created by the market maker, what is trend following is the direction that follow them. This is the realization and coming. And also, when Freddy told me when they are adding gamma, and we can see that the next GEX is 260 billion on the long side, okay? And you have them adding 10 billion, this is billion, it's not million, 11 billion, they are adding gamma, so they want to continue up. And this is an amazing confirmation for me to know that most probably we will continue to the protection level, okay? Yeah. These guys, it's a aha moment also for me. Like I wanted only to teach order flow, but Fred is lecturing everyone in here. And this is the reason I will improve the system, guys, and I will have a system that implement both the option flow and the order flow. So you have the two main forces of the market. Imagine you have the direction and the accelerator. Okay, so you know the direction you are going, and you know the probability that you are going there. And we have also the level here. Now it's loading. If I learn correctly, Freddy, we have a lot of fuel, so we can continue a little bit higher to the 29,808 for today, even higher. They are adding gamma, and on the next session, guys, we will go over the practical example, and I will try to build the AAA++, that it's option flow aligned with order flow. And please help me in the chat to give a warm thanks to Freddy for the time he took. It's not easy to catch someone that is willing to teach after an institutional space. He could stay for himself just trading, okay? And thank you very much for the time you took, Freddy. I cannot wait for the other lesson. And thank you, everyone, guys. Leave me a feedback. If you didn't left a review, leave me a feedback about what you think in the battlefield section. And see you on the next week. And hope you can learn and implement this in your trading. What I will try to do is to keep updated all in the section, every opening of the market, with this representation here. So you can know from the classic, from the state, the most important level. Thank you, guys. Thank Freddy. Have a good day and see you next week.
Yeah, see you on Tuesday. And hopefully, yeah, on Tuesday, we're going to learn but you know, to go into GEXBot and see how the levels work. But really today, and as Fabio says, it's not easy because basically take me 10 to 12 hours to explain this. So try to do it in 2 hours. I know it was quick, but that's the core things you guys to understand that
Freddy,
the market maker is moving.
I think that if it takes, instead of 4 hours, it takes 6 hours, okay, the people will not complain, okay? The people will just say, look, it's an interesting topic. This is something that you need to learn one time in your lifetime, the option flow, okay? And we can do, for example, after the option flow, the charting next week, okay? It's not a problem at all, okay? So I forgot, as always, disclaimer. Even if you have option flow, even if you have order flow, probably you are really dumb if you go opposite to the direction, but the financial markets are a concept of probability and risk, okay? So always the risk that you put in the market is not guaranteed, and blah, blah, blah. Read the disclaimer that is mandatory for everyone, okay? Bye, guys. Have a great day. Thank you for the time, Freddy.
See ya. Take care, guys. Bye-bye.